Everybody, this is John. Welcome to the free video. Pretty fun trading day. I love these like violently sideways days in this kind of a market. I mean, if you're prepared for them. And they're good both for futures and for options. One of the things that we've been looking at on Google is during yesterday's reversal, we came down to 3 ATR. Now, I know it's funny because there's a lot of people here who are super bearish. I'm one of them. And there's a lot of people here who are super short, okay, and at risk of just getting obliterated by a short covering rally. So we've been playing things kind of light, staying like an 85% cash and just kind of nibbling here and there. So one of the trades we'd set up on Google was yesterday when we kind of reversed and closed strong, set an at the money put credit spread. And a lot of times people were asking like, well, you know, why not buy like 5 call options, you know, instead of 20 put credit spreads? Well, the objective here is that we could actually get back to the mean, and 5 call options, you know, would be X. Well, and the idea is that, well, if you sell a put credit spread, you're just limiting your profitability. And of course, that's a logical question to ask, except of course it doesn't take into account the much higher probability you have of making money on the put credit spread should Google just trade sideways. Okay, so you know, if your max profit, if you bought 5 calls, your max profit is going to be, you know, let's just call it $1,000, and you know you're risking $1,000 to get it. Well, great, you can set up enough put credit spread so that even if Google rallies to 100, which you wouldn't, you know, let's be honest here, you wouldn't have held on to those 5 calls, you'd have taken profits, that you still can make the same amount of money on that put credit spread that you would have on the calls. You just have to sell more spreads. So on this one, so the question then becomes, all right, so great, we sold that at the time, the at the money put credit spread for 410, okay, which is nice. And I like, obviously it's higher probability if you sell it like say 1 standard deviation out. But what I like about this is you get closer to a 1-to-1 risk reward ratio, you know, as opposed to, you know, if you sell 2 standard deviations out and then the market just opens up with a flash crash, you know, you're risking 20 to make 1, and just one of those can destroy your last 19 profitable trades, whereas something like this I think is a lot more manageable. So now we sold it at 410, and yes, if we would have had 5 options, then today we would have made what would have been like with the option. If the stock is up like 12 points, we'd have made about 6 points on the option, would have made about $3,000. With 20 put spreads, we made about the same amount, not exactly the same, but so you can kind of map it out that way. And at this point the question is when do you buy it back? I'd be fine buying it back at 80% of profit. We want to keep in mind expected move into the end of the week is $14, and then we've got the options that expire in 10 days. So even though we're still well within the expected move, not only for this week, but obviously for next week. So we just want to obviously just kind of keep an eye on things and how it's doing. The good news is Google had fairly good relative strength in relation to the market today. All right. The other thing that you can do with this is a diagonal, which we're going to look at setting up tomorrow. And all that means is we can sit there and say, okay, great. We're looking for Google to go back to the mean, right? Then what I want to do is I would like to look at, say, the 760 calls and sell those, okay? And I can just kind of come over here and say, all right, I want to sell those 760 calls there, but then I want to go out, actually that's fine, Jan 4, and buy a little bit more. I actually prefer a little bit more in the money there, so let's call it 755. So in a perfect world, what happens on something like this is that, you know, you own a 755 call that expires next week, but you sell the 760 call that expires this week, okay? And then in a perfect world, the 760 call expires worthless, and then as long as Google is holding out okay, you can hold the 755 call into next week and turn it into a vertical. It's a pretty awesome strategy, and it makes you theta positive the whole time. Okay, so if what I just talked about seems a little confusing, and by the way, it's a fantastic strategy, and if you're just getting into options, or even if you've been doing it for a while, utilizing diagonals it's just the best of both worlds. You can hang on to kind of a longer term option to catch the balance of a move, but then sell. It's almost like having a rental property. Sell income against that each week using diagonals or turn it into a vertical. It just offers a ton of flexibility. Bruce is going to be teaching an intermediate to advanced class on how to do this. Now, if you've never done it before, that's okay. He's going to kind of, do a little bit of step by step, but then he's going to dive right into it. This class is coming up Wednesday, January 13th from 6 to 9 Central. It's a 3-hour class, okay? Just $197. Again, the idea with this is on 1 or 2 trades, trading a 1 lot, you could cover the investment, this investment in yourself and your own knowledge of this class. And then from there, he's also going to do live trading. So you can see how to do it live. If you want to do that, it's $297, and that of course includes this class, okay? The link is simpleroptions.com/flex. He's going to be talking about why this is the most flexible trade in my toolbox, okay? And this is what I do too. The main difference between Bruce and I is I just do it a little bit shorter term, okay? I like to do this with weekly options, and while Bruce will do it with weekly options, he's also doing it more for kind of brain dead income strategies 30 and 60 days out as well. How to set it up to be a directional theta positive position. This is kind of the key to success in trading options. How to set it up with little to no cost other than margin. That's awesome. And then how to choose the best stocks and ETFs to trade them on. All right, so very important class, very good tools for your toolbox. Looking forward to seeing you on the class.